I see it just went live.
Yes, we could
Got
be
it.
live.
I just got the notification.
Okay,
I think we're live. I see me. I see you.
perfect. Let's get the go ahead from Nick, and we will finally get rolling. Excellent condition, says YouTube. Yeah, all right. Finally, we got it. All right. We're getting closer. Okay, great. All right. My career as a film production studio guy is quickly going out the window. All right, let's do this. Kyle,
What's up?
happy Thursday. How are you?
Good. How are you doing?
I'm good. I'm good. We're getting closer to this, and again, to clients who have to refresh. There's just a few bugs we're trying to work through in this software. It's driving me nuts, but we'll get it. But we have a lot of good content for you today. What's going on your end? How's the baby?
Baby's good. Tech issues aside, everything's great.
It's kind
Just
of par for the course at this
got
point.
yeah. For now, we're gonna fix it, and then it'll be great. It's just new streaming software and getting all it to work. So
Yeah, exactly. But yeah, we're good. Other than that, everything's good. Markets are selling off a bit. There's been some inflation talk, some rate talk. We have Nvidia earnings coming up here next week. So yeah, we'll get into it a little bit. A few things that we've talked about as we're kind of moving out of the summer doldrums into the back quarter, last quarter of the year. We're obviously going to tighten up the communications. Kyle's been doing a wonderful job on the planning side. The feedback from Social Security and the trust stuff was really good. So it just makes sense to kind of piece that out and get it out of the market analysis stuff. It needs to stand on its own. So, we're going to continue to adapt as we're figuring out this stupid technology. The content will shift as well and try to make these pieces a little bit more bite size. So,
yep.
Some of the stuff we're going on there. Anything you want to hit on that one, Kyle, or
Yeah, I'll just reiterate. I'm
yeah,
planning to do at least probably 10 videos on the planning side here in the
nice.
next month and a half or so, and have YouTube have a folder with all of that. So if you want to dig into planning, you can do it there. And then we're planning to make these more market economic
Yeah.
and just more business update stuff, just to so you don't have to wade through either subject to get to one or the other. We'll just break them out from here
Yep.
going forward.
Exactly. All right. Sounds good. Let's dive in. It is the 21st. Holy cow. Just over a week left in August. And we'll be looking at Q4. Unreal.
Mm.
So this one's kind of fun. This is going to be a good balance of fundamental macro analysis, specifically Fed interest rate expectations, some housing. But then, I kind of missed a little bit the technicals of my old world. So we're going to hit the market technicals fairly heavy today. It's probably good, Kyle, we're not doing a planning end because I think we have a lot of content today. So in the interest of,
Yeah.
keeping it somewhat tight, we're going to move through. I'm glad we're not doing planning because, as you said, it needs to stand on its own, and there's so much going on in the markets right now.
Yeah. Markets have really woken up.
Yeah, it's been quiet, a little sell off, but we'll try to piece it together for you here. So, going to be trying to watch comments over here. And just if you're watching on YouTube and you have the chat screen, just type in hello for me. I just want to see if it comes through on the screen so we can monitor comments here. All right, so the next Fed meeting is going to be September 17th, and the big thing is, when are they going to cut? We were at 92% chance of a cut last week, and now we're at 77. Kyle, we've seen this movie before. In 1 week they've dropped it, 15% or so, and we still have just under a month until that September meeting, so that can go anywhere, right? We're at a 7% chance of almost 8% of no cut a week ago, and now the market's at 23%. What do you think? Do we cut or not in September?
I think we do cut.
Okay.
The odds are still there. The odds were, much higher, a little, or lower, I guess, a little over a month ago. They were at like 53%. I know they're at, if you go a month back from today, it said 58. So the chance of a cut has gone up. It's gone back down, but I think inflation is close enough where they can't, or it'll be harder for them to cite that as a reason not to cut.
Yep.
And then I think the further away we get from the April tariff explosion with all of that creating inflation risk, we've seen in reality that the tariffs aren't creating that type of inflation, and the threat was bigger than the reality. So I think people are going to start to see that certainty of tariffs not blowing up like they've been threatened.
Yeah. The bark is worse than the bite. And there's actually a 10-year inflation expectation chart I have for you. I don't know if you've looked at it yet. We were cooking all morning on this presentation, and inflation expectations have actually come in, which is interesting. Is it, I don't want to jump ahead. We'll get into it. Okay. So that's that. And then here's the glide path lower into this time and beyond next year. So right now the Fed funds is 4.25, 4.5. So the expectation on the September 17th meeting, 77% chance on a cumulative basis that we go down a quarter to 4 to 4.25. On hold in October, again in December. And what this is saying is collectively there's a 91.8% chance that will be 50 basis points lower. 50 basis points, of course, is 0.5% on the Fed funds. Then in January, markets are saying we're on hold until June of next year, and then on down. But these can change. So we'll see. And the big thing is, there's such a debate out there. Do we need to cut? Is there softness in the economy, or is there inflation on a sustained glide path towards the Fed's 2% target where we can cut? Should we cut? There's a big debate out there. And how does the market handle both scenarios where the Fed does cut rates? And does the market decide once we get there, what does the Fed know that we don't about the economy? And maybe that's a sign of weakness. Or are they succumbing to political pressure? That would be an interesting reality that we may face when they cut. How does the market interpret that day of? And if they don't cut, how does the market interpret that? They're saying, wow, the Fed actually believes the market's in a firmer position than we think. It's all about the reaction function based on what's happening. I also forgot to mention, I am on CNBC. I didn't even tell you this. Oops. I didn't even tell you this yet. I'm on CNBC tomorrow. Oops, I just messed that up too. Presenter view. I'm on CNBC tomorrow, Kyle, at 5:30, so that'll be fun. I'm going to have you help me prep for that one.
Cool. Yeah.
And I just broke it.
And
yeah, go ahead.
I should have added a slide on this, and I was looking at it yesterday, but the Fed, one thing they do is set interest rates. The other thing they do is called open market operations, where they're out buying security.
Ooh, I think we just lost Kyle. I think we just lost Kyle in there. Are you there? All right, I think maybe Powell didn't like what Kyle was saying, but I think we lost him. Let's see if he's able to log back in, but we'll keep going here. I know he was talking about open market operations, and I'm trying to think where he's going with that, with Treasury purchases to adjust yields. Hopefully he kicks back in, and we'll see where he's going on that. But, let's keep going. The U.S. yield market, as I mentioned, the 10-year yield in the past, this is the foundation of, where, benchmark interest rates are set with car loans, and 30-year mortgage actually has the biggest correlation to the 10-year yield. And this is kind of like the heartbeat interest rate of America to steal the old Chevy commercial. And what's interesting is the 10-year yield really in 2024, 25 has been constricted quite a bit into kind of a coiled spring. So which way does it go, higher or lower? We'll have to see. I'm not going to make a bet, but it's amazing how much the volatility has contracted. Okay. Let me just make sure we're still good here.
And I'm back now.
You're back?
Yeah, sorry. I'm changing my internet to slower but more reliable internet from
slower internet.
But more reliable because it's underground cables instead of on the power line attachment. Which I think
so make your point on open market operations. Where were we?
Sorry to get cut off mid-sentence.
That's okay. Go ahead.
It's been more neutral on the open market operation side, and still what I would call most people would call contractionary on the interest rate side. So we see rates, but what we don't see is the Fed slowing down their purchases of securities, which has been happening over the past couple of years. So I'll add some slides for that next time. But it's important to note that they are getting more neutral, just not as much on the rate side for whatever reason. Definitely worth exploring.
Yet they're still rolling off the balance sheet, though, right?
Exactly. That's what I'm saying. Yeah.
Okay.
They've gotten way more neutral on that side versus more stimulus, more buying. They've slowed that down.
Right. Where actually they're not letting. Yeah. That's going to be a longer discussion, but yeah, they are letting the expiring maturities, both mortgage and treasury debt, roll off and not rolling them out and reissuing them to keep the balance sheet high. So, yep. All right. So inflation expectations, and this is what I was kind of alluding to. This is interesting. This is really just in the last 2 months. This is the 10-year inflation expectation has taken a pretty sharp decline. It's also noticeable in the 5-year, not as quite noticeable on the 2-year, but the absolute level is pretty significant. So the 10-year expected inflation, where the market threw a basket in quite a formula, various calculations that the Cleveland Fed will put up to 2.10, where the Fed's target is 2, right? So what has changed over the last month or two, with, as you said, as Kyle mentioned, with tariffs again on our doorstep, markets at highs, we have a housing situation as well, continued high housing prices, that's inflationary, but we have supply issues on the builder side. So why is inflation expectations dropping with the Fed, at 77% chance of cutting in September? Is that starting to, as the market's starting to tell us that something is weakening? And, there's a disconnect, I think, between what's happening in the underlying economy and the AI, artificial intelligence, tech boom that we're undergoing. Could it be could that be viewed as a little bit of a safety trade despite what's going on in the underlying economy? Possibly. But, we just have to, as I think we'll build out the case between what's happening on the technological boom, AI build out, and what's happening in the underlying economy. I think I might present to you guys here the takeaway that we might be coming up in a little bit of weakness. And I hope I'm wrong, but I'm starting to see this, and that's going to dictate how we manage the portfolios. So this is going to be the 10-year yield. Again, same thing. This is that really tight, Kyle, when you were out, I was showing them on the 10-year chart, the nominal yield, how tight this guy is getting. Really just like kind of a coiled spring here after such a big move up post-COVID. Same chart is right here in green, but the real yield is going to be expected inflation factored into the nominal yield. The real yield is dropping, and that's very much related to the drop in expected inflation, right? So what happens is if the expected inflation drops, you're making your 4.5% or 4.3% in your 10-year yield, but the payments that you're receiving on your bond coupon payments, if they're being inflated less, you're actually receiving more money, and that's the concept of real yield. So the real yield is dropping, inflation expectations is dropping. What does that mean for the economy? And again, we're going to try to kind of pull this together. So it's helpful and complicated to look at rates not just isolated like a 10-year maturity, which I said has a big impact throughout the economy, or the 30-year, which is very long-term, 10-year, 5-year, 2-year, and that's when you start looking at where the Fed operates in the short-term maturities, the yield on the 2-year Treasury and the 3-month bill. That's where the Fed operates. And it's the difference between those two that creates the yield curve, and we've discussed that quite a bit on these streams. And most investors don't want to talk about it or don't understand it, and that's fine because it's complicated, it's a little convoluted, but it's become so important post-COVID as we finally got interest rates to start moving, because prior to 2020 off the chart here, they didn't move at all. Rates were just basically 2.5%. We were very quiet, and now all of a sudden the move in interest rates has been quite significant, which was the global financial crisis, but also COVID. So it's the interaction between the short-term and the long-term rate that is supposed to be the barometer or the gauge of the health of the economy. So the story I'm going to try to tell you here is, this is the yield curve. Okay, what that means is this is just simply the yield, the corresponding yield on a 3-month bill, the 2-year, the 5-year, the 7-year, 10-year, 20, and 30. And it's how and where that creates, once you connect all the dots, the shape of the so-called yield curve is thought to be a leading indicator as to where the economy and the stock market is headed. And when the short-term rates are above the long-term rates, meaning short-term Fed funds, which operates right in here, are higher than the more market-dictated yields on the 20 and 30-year U.S. Treasuries, that is going to be the sign of an economic slowdown. And that was the yield curve position into 2000. And once the market sold off here, this is the S&P in blue, right here, what did the Fed do? The Fed cut interest rates to create a yield curve, which is a steep yield curve, which that's the shape of a recovering economy. The one back here, when short-term rates are above long-term rates, that's called the inverted yield curve. And that usually foretells recession. So post-tech bubble, the Fed cut, creating a normally shaped or a steep yield curve, which sets the stage for recovery, which is what happened. Here we go in 2006. It was kind of a flattish yield curve, but you would say that the short-term rates are a little bit above long-term rates, and then we had the GFC. After the GFC, of course, the Fed slashed rates to zero, and that created the shape of a recovering yield curve. So as we fast forward to today, it's interesting. In August, we actually had quite significant yield curve inversion, and this is August of 24. Okay, this is 1 year ago. We had short-term rates quite significantly higher than the long-term rates, but the Fed addressed that. addressed that pretty quickly. What happened is the Fed cut once in 2024, and you can see the short-term yield went from, call it 5.25 or so, just below 4. So the short-term rates did drop, but what happened is the longer-term rates actually went up. So the longer-term rates were hanging below this 4.65%. Now the longer-term rates are above 4.65. So those longer-term treasuries sold off, longer term rates went up. That's a little concerning. When the longer term treasuries are selling off, why do people not want to hold those long term treasuries? Are they flying into the stock market? Maybe. Or do they not want to hold long term treasuries for whatever reason? Maybe the fiscal position of the US, our ongoing budget deficits and our national debt, or, is it inflation expectations fearful in the future? Or again, is it the stock market bid? Kyle, is there anything you want to jump in on there? Is there anything that I'm missing or you want to tighten up?
No, that's a great summary. It's dynamic. It's not inverse right now, which is what you want to see. So I think ultimately that's a good thing, but it definitely is concerning that the long-term rates would spike that much. On the positive side, you could say that is expectation of faster growth in the future, but yeah, it is. I can see the risks there too.
Well, all right. So let me ask you, is it you handle more of the fixed income on, our side, our clients, which is obviously an incredibly small micro sample, our clients rushing in and saying, Kyle, let's tighten up our fixed income. I want to increase fixed income.
So the interest rate risk right now is people are definitely worried by that of rates devaluing longer term investments. So we've been out of lowering the interest rate risk of our model in order to just kind of stay out of that. It's so much uncertainty right now. You could see even rates increase more, which would hurt long-term bond prices. So that's something that we've kind of avoided the interest rate risk and really limited it, and then taken more of our risk. I mean, really, we want to take the risk that we take on the equity side to stretch for return on that side and play it more safe on the fixed income side. But we've gone more into high yield, I would say.
Yeah.
Just with Trump being in office, very business friendly. We saw the bailout of was it Signature, I think, Bank. It was a year or two ago. We saw the Fed, government coming in to help them. Same with UBS and Swiss Bank. So, for me, just recently, with all the uncertainty with interest rates, and I think a lot of our clients in fixed income agree.
They just don't want the duration risk, is what you're saying.
Yeah, definitely.
And there's not that much of a premium. Back to the slide, there's not that much of a premium to go out 20, 30 years. I mean, your short term is,
right.
4.25. Your long term is just sub 5.
Exactly.
Why go out?
Yeah. And it seems high, but the long term average on the 10-year is around 4.61. I think we had that in a slide a few weeks ago.
Right.
So if you look at around the 80s when we had extremely high rates. I mean, that's something that could happen too, and then further drive down those long-term bond prices, which would create an attractive entry point in the future. If we're talking about rates going down, if they go up, that would create an attractive entry point for longer term bonds, which yields go down and those would go up in prices with a higher duration. But right now, I feel like you showed the coil. I feel like that's accurate, because if we see inflation stay higher, GDP growth stay higher, we would see rates probably go up. If we see a slowdown, we would see rates go down significantly as the Fed lowers interest rates to stave off recession. So it's kind of a risky inflection point to be in, and that's why we eliminated a lot of the interest rate risk in our fixed income model.
Well said. And me, I loathe and detest the sensationalistic people out there who just try to scare the shit out of you to grab your attention. I'm not that way, and it's served us well in terms of the investing mindset and our returns. But I mean, these macro markets like the gold and dollar and rates, like these can go sideways longer than we think, and
Mhm.
that would be ideal, right? But
Yeah.
either way, like I don't know, this is getting pretty tight.
Yeah. And so, from management standpoint, why take that risk when it's such a I mean, anyone who tells you they can predict where rates are going is,
Right.
I mean, even these Fed, they're always the
Yeah.
Fed kind of glide path to where they want it to be.
Yeah.
It pretty much looked the same since early 2023 when they were projecting 6 rate cuts, and I think we got one or none. So
Right.
it's,
Yeah. Yeah. Yeah.
they don't know either. And
Yeah. For
so,
sure,
you
they
know,
definitely don't know. And that makes, from a planning point of view, corporate planning as well as individual financial planning. When the uncertainty for longer term rates is so high, that makes your job harder in terms of the financial planning with our clients. We can
mhm,
manage the volatility in their equity portfolios within their individual financial plans easier than we can the fixed income portfolio that so closely goes in and ties to the short, medium, long term goals that our clients have, right?
absolutely. Yeah. That leads back, I kind of mentioned it, but why take so much risk on the fixed income side? It's supposed to be the defensive part of your portfolio. So from a planning angle, I'd rather be in a more stable fixed income model, which is what we've built towards, with like half of our bonds in that model under a year. So that's, very stable compared to what you would see with like the bond index, the US aggregate,
Yeah.
swinging a lot with rates, and that allows us to take more, target a higher risk adjusted return on the equity side, which I think makes sense if you look at, historically speaking, how much equities have yielded and how much bonds have yielded, which has been, much lower than on the equity side.
It's well said. It's like, on the yield curve side, oh, where am I going? Right. Like how much, where am I right here? Like how much higher can the long-term rates go? How much higher? It's not a bear steepener in terms of like to really get into the macro. Like how much higher can these long-term yields go for everything that you're saying? Steepening the yield curve, not from the Fed cutting in the short term, but long-term rates and long-term bonds being sold off, steepening the yield curve. Like how long can that go before that hits either investment psychology, just this, the confidence in the economy. So much of the financing seems to be much more short term focused. Like, what's the,
Mm-hmm.
and there's no answer to this. I mean, if you have a feeling, just if you have an idea, tell me. I'm not just saying like, just, pay me lip service on this, but like, how much higher can these long term rates go, steepening the yield curve, which is the shape of a solid economy, before we hit the tipping point? Is there an answer? Like, I don't know.
Yeah, that's a good question, and I'd want to go look at historical rate levels and try and, I mean, I guess the answer would be where we would actually find out. I mean, I think the biggest risk for inflation is tariffs. So if things
But
do
you said
descend,
earlier the bark is louder than the bite.
yeah, if we descend and
Oh no, your internet. He was winding up.
serious,
Oh, you're back now. You're back. You were
yeah,
winding up
right
for a
as I
good
thought.
point.
Yeah, no, I'd put in, I mean, I'm starting to tie the tariffs. The tariffs have started to turn into sanctions in a way, and I hit on this last week with China, India, and the Russia, Trump Putin negotiation. Trump has threatened like extremely high tariffs on countries like China and India
Yeah.
for buying stuff from Russia.
Yeah.
And so, I think there's a case where things kind of devolve on that side. And we do see extremely high, like punitive, call them tariffs, but they're really kind of sanctions, So
Interesting.
I
Yep.
think that would be the most likely scenario where we find out, because if all of these goods getting imported start seeing a heavy tariff,
Yeah.
it creates a supply shock. I think that's honestly a realistic, assuming things go that way, we could very well find out what a big shock, like April, but actually more permanent, looks like if you do start tying these sanctions to global geopolitics and things like that.
Yeah. Or Trump's going to continue to kick the can down the road and just inject the media with a lot of headlines, but really just do nothing, keep pushing it out to give these companies more time to onshore and reshore and get out of China. Like, anyway, we got to get you new internet. You keep cutting out. All right.
I'm switching to hotspot. I'm going to do it now.
All right. If it's fast enough. All right. We'll keep moving. Good discussion though. So this chart just continues to kill me. $7.4 trillion. I meant to put a cute little picture of a piggy bank in here. I didn't do it. But 7.4 trillion in money markets with interest rates expected to drop 50 bips this year. Like, if the yield that can be made on money markets is going to be dropping as everything else, as rates are dropping, with that coiled spring and the 10-year yield in your back of my mind, like, where's that money going to be headed? I have to think, with the way earnings have been, the market is progressing, like, I have to think that the stock market would be a partial beneficiary of money if and when this massive move into money markets starts to top out, which is interesting that the peak of this mountain is right here. Maybe that's a leading indicator here at Inside Edge. Kyle, are you with me?
Yeah, I'm here.
That you're supposed to laugh at that. See how the peak is like right there. Maybe it gets up to 8.5 trillion before we start moving lower. I don't know. We'll see.
Yeah, I think it'll go until rates drop, and then you'll see a huge reallocation. I mean,
Yeah.
if you're getting 4.5 for a short-term yield, that's pretty good and well above inflation. So
Yeah.
I don't blame it. Don't blame it, but yeah, a lot of money to be on the sidelines.
Yeah.
No question.
Yeah. All right, let's get a little market technicals here. Let's just have a quick discussion on this. I kind of consider myself like a visual investor. Like, we could get in and we've looked at the spreadsheets. Kyle and I have gone through and literally downloaded the Fed's GDP in terms of their spending and their trade deficit, overseas imports, exports, in terms of securities. Like, we've gone through crazy spreadsheets, but there's also a great way to look at the markets through your eyes in terms of what's actually happening. The markets, interest rates, and FX, and commodities, and stocks, and all these different things. Like, it's great to look at what's actually happening, because it winds up being a really good sort of quick way to cut through all the data that's out there that we do look at to build our portfolios. But the market is unbelievable in terms of like the way the market will adapt to the information that's coming in, and it's a quick way to sort of filter that incoming information. So like, I consider myself a visual investor. So I started out when I was a trader when I was 21 years old, 2021 in San Diego, short-term day trading. And as I've gotten older, I've gone through multiple evolutions of trading and investing. But I was built as a chart analyst to look at and interpret, what the psychology that's driving the individual market, how it's reacting to incoming data and reacting to expected data down the line. So I'll forever be a chartist. I don't know. It's a wonderful way. I think it's the good balance of fundamentals and technicals that makes you a good investor, because you can have a great fundamental idea of what should happen, but unless the trillions of dollars sloshing around the markets agrees with you, you're going to get run over. So, what's going on in the market? This is the NASDAQ 100. So the 100 largest, not only tech stocks, but it's got other sectors in there. We're going back from 21. There's the big tech growth rotation out into value in 2022. That was really fun. We launched the firm right here, Kyle. You weren't with me yet. We launched in October 21, went up for a little bit, and as soon as we launched inside Edge Capital, wham! And the fact that we made it through that, I would say quite well, was awesome. When did you come on? You came on, oh man, your stupid internet. Sorry. Yeah, he came in right about here, right about there, I think. And then the market rallied up, sold off, and here we are now up at the highs. So this is the weekly chart. Each bar represents 1 week. Not too much to report, but what I tried to show you here is this subsection here of the NASDAQ 100 is all down here on the daily. Okay, so this is now the daily chart. And you know what we're seeing here over the last couple of days, we've seen a sell-off. You know, earnings were good. We have some concerns about inflation. We've sold down to the 50-day moving average, which, you know, from April of this year, this is the blue dotted line here. I know it's hard to see. We haven't been below it yet. We came down and tested it, which is fine. It's completely normal. It's, you know, not that concerning, but, you know, it's just a little bit of a sell-off. So I just wanted to just bring that to your attention here. This is the NASDAQ's ETF, the QQQ. This is the sell-off, just, you know, basically what we're looking at, same thing is this chart in here. This is the NASDAQ 100 index. This is the ETF that tracks that NASDAQ 100. It was a pretty good volume day yesterday. August 20th, largest volume day since April back here, which I'm not even showing you the chart, but it was a pretty big reversal day. I haven't looked at the market in the last hour or so, but we're kind of, this little cross is today's price action inside of this candle pattern. When you have a big volume move down there close to that 50-day, that kind of tells you there's some technical support coming in the market. So could this, you know, manifest into something greater as we go into a seasonally weak period, which is September? Yeah, it could. I'm going to be watching this closely. But right now I'm not very concerned. This is kind of fun. So these are two ETFs, Vanguard's flagship growth ETF, you know, very tech, NASDAQ, you know, NASDAQ-esque sort of ETF with Amazon, Apple, Microsoft, NVIDIA. That's the growth ETF in green, and then the value ETF, you know, think, you know, Exxon and Procter & Gamble, and I think IBM's in there and stuff like that. So more value, dividend paying, lower beta stocks. You know, as the NASDAQ and everything is sold off, what you're seeing, the whole point of this little chart is growth is sold off in green a touch as the value ETF has showed pretty good relative strength. And that's really just in August. It's August, it's summer. Last August, I remember ripping home from the beach when we had that big drop in interest rates, the yen carry unwind. You know, it wound up being just the summer kind of cats away, the mice will play sort of situation. We're getting a little bit of a sell-off here in August, you know, with 9 days left to go. We'll see if it manifests anymore, but I'm not overly concerned. And last year's big drop really didn't turn into anything either. This is getting a little bit more wonky, but this is taking the Vanguard growth, VUG, and dividing it into the VTV, which is the Vanguard value. And it's the relative relationship between the two, growth and value, that will give you a feel as to how the market and the overall economy is doing. Is the stock market preferring growth stocks or value stocks? And as this line is going up, that means the market is preferring growth over value. So this was 2020, 2021. There was 2022 sell-off. As this is selling off, that means growth is selling off relative to value. Value is stronger relative to growth. And that's the ratio selling off. We bottomed out in 23 and we've been rallying back. So, you know, this was obviously a pivot point. It was a high. We came back, tested a support, and we bounced up. There is a technical pattern from my old world called 3 drives to a high. When you kind of get 3 spikes like this, sometimes that's concerning. It is concerning, and sometimes it winds up being a reversal. So, you know, with the move down, inflation expectations, with the Fed, you know, expected to cut 2, is the market, as I was saying, being the visual investor that we are, is starting to tell us that maybe markets are telling us maybe there's some economic weakness coming in, as Kyle was mentioned. tariffs turning into kind of sanctions on Russia and China. I'm kind of monitoring this value growth ratio. Okay. This is another way to look at that exact same, those two ETFs, Vanguard Growth, VUG, Vanguard Value, ETF. So this is the relative rotation graphs invented by Julius de Kepenar. We worked together for a good year. This is a kind of a wonderful way to look at how they move. And if I had, this is just a screenshot, but if I had the live charts up, I could show you and scroll how they literally, they move. They actually circle around from leading, weakening, lagging to improving. And what we've seen over the last 2 years is the growth VUG go from improving all the way into leading. And we've dropped down into weakening. The question is, are we going to do a full rotation and growth moves into lagging? And what'll happen is if that happens, VTV, which is value, goes from improving into leading, which means value stocks are now in control. That usually means flight to safety, recession. Overall market is selling off as the market moves into value. So we've got to watch this. And what you're seeing here is just over the last 2 months, we're starting to see a little bit of a hook up in growth. Okay, this is the weekly. Okay, each one of these dots is 1 week. Actually, so sorry, that's a miss. I need to change that. It's 12-week trail. So each one of these dots is weeks. So we have seen a move in the last 12 weeks into growth, and that's going to correspond with this little hook here on the monthly. Each one of the dots over here is one month. Okay, so we've seen a little bit of a hook up in growth. So basically, what we want to see if we want to continue to be bullish the market is growth VUG to stay on this side of the weekly chart, and on the monthly, this guy to hook back up this way. It's something I'm going to be managing and watching closely. Combine, and again, those of you who know me from the old world and studied your technicals a little bit, we would need this VUG VTV ratio to start moving up and to disregard this so-called reversal pattern, which is 3 drives to a high. If we can disregard that and move up through 2.4, 2.5, 2.6, growth stocks are in control. NASDAQ continues to outpace the gains seen in the S&P and, party on with AI. So I'm watching. Those of you who are in Active Ops, Active Opportunities, that's our short-term speedboat model. We do have a VIX hedge on right now. This is kind of what I'm going to be talking about tomorrow morning on CNBC. So, VIX is cheap, and the VIX is going to be how expensive options are in the S&P 500. So they trade options in the SPX, S&P 500, and basically the more expensive the options are, the more usually people are paying for protection by buying puts. Puts are, think of it like, fire insurance on your house, right? People don't panic into buying calls, which is like, calls benefit if the market moves up. Puts benefit if the stock market moves down. People will put a premium into puts because obviously they want to pay for downside protection. The lower the VIX is, the cheaper that protection is. That means both puts and calls are cheaper, right? And those of you who really know what I'm talking about so far will be familiar with something called the vol skew, which means there's an embedded premium in puts than there is in calls because people will pay more for protection. Greed is a weaker emotion than fear. Fear is a stronger emotion than greed. People pay for protection in puts, and there's going to be a more expensive premium on puts than there is in calls. That was discovered during the 1987 crash, which is when the so-called vol skew was discovered. So point of all that is there's usually a premium of puts over calls because people panic when the market crashes. People don't panic when the market crashes higher. All right. So what that means all together is the VIX is hanging at 16, 16 and a half, 17. It's pretty cheap relative to where it's been. Not shown in this chart, but you've seen VIX hanging in at a 10, 11, 12. That was pre-COVID. That was really cheap. Now, with interest rates moving up, inflation more embedded in the system, the new norm for low VIX is 14, 15, 16, and we're kind of there. What that means is volatility is pretty cheap right now. that you can buy, some put options on the S&P, or you can buy call options on the VIX, which, as you'll see, the two move inverse to another. As the stock market sells off, here's the S&P in white and gray, you're seeing the VIX, the fear, move up, which means people are paying for those options, and particularly those put options, which are downside protection. So yeah, we've seen a little bit of a move up. We are carrying a call spread in the VIX. So I bought the 23 strike call in the VIX right here and sold the 29. If we get or break through this uptrend in the S&P for all the reasons that that Kyle and I mentioned, you may see the VIX start to move up here. So we put on some cheap protection. I cut half of the trade. I still have half on. I cut half of it because the market made a new high. Now we're selling off again. We're still underwater in the trade, which is fine. Hopefully you lose money in your insurance policy. Like, I don't want to have to cash my insurance policy if it burns down, right? I'd rather have it expire worthless and the stock market stays high. But, I think it's a good time. So that's why we're holding in the Active Opps portfolio at Inside Edge this call spread. Investors, if it's something that you want to be involved in, call us, email us, let us know. You know how to get a hold of Kyle and I. If it's something you want to hold separately in your account, we can talk about it and pretty easily set it up. So I think we may continue to do this to hold some hedges, it's probably good to do it while it's cheap, not when the VIX is up here, or certainly up here like we saw in the beginning of 2025. Okay. More technicals. I told you it's kind of technical Thursday here. So this is the NYSE advancing stocks minus declining stocks. And it's the sort of grayed out behind this chart that you can't see. I put a 15-period moving average on the advancing stocks minus declining stocks to kind of allow us to, compare it against the S&P. What you're seeing here is the S&P moving up in August, September, November, December of last year as the moving average of advanced decline moves lower, which means there's not as many advancing stocks as declining stocks. And that did set up the sell-off into Q1 of this year. It's kind of happening again, but you got to be careful drawing such a clear comparison because, obviously the moving average of advanced decline is very much sideways. It doesn't trend unlike the stock market does. So it's not like go buy a bunch of VIX call spreads and get out of your positions because, there's a lot of false signals as well. Like look at this. So we make a high here and a lower high here, but the stock market just disregards and continues to move up. So, be careful kind of drawing too much of a conclusion in that one. Okay. Kyle, are you back?
Yeah, I'm here.
Cool.
So onto the housing market, wanted to put together a few slides as the housing market's had a tough time with rates being higher and then just supply demand dynamics with home builders and houses coming on market. So to start, just a note on just how the real estate ETF XLRE has done year to date, up 3.4% versus 8.86% for the S&P 500. So it's up for the year. You can see it did react poorly to the early April tariff spike or drop there, spike down, and has since recovered. And I mean, to summarize everything, the home prices, which you can see a headline here, are still going up, hit a record high if you look nationally, and elevated mortgage rates, which we have a couple charts on coming up. These two things are kind of keeping a lid on housing in terms of prices and people being able to move and get a reasonable mortgage rate. In some, most cases, people have a lower mortgage rate that they're paying on where they live, so it kind of disincentivizes them from moving. So that's been going on so far this year, and the interest rate, potentially dropping later this year. That's probably more of a focus for housing people in the housing market or housing industry than probably anyone else. So very important just based on on how that industry works with a lot of financing. Next slide, there's a home builder sentiment survey that just came out, slightly decreased in August versus an expected increase. And again, that's on elevated mortgage rates, which I put in a chart here. You can see they've actually come down quite a bit.
Yeah, they have quite a bit.
So yeah, around 6.61, I think is what it is. And that's, it's a step in the right direction, but that's still more expensive than historical. So, it's a step, but probably not enough to kind of unlock all of these people that are waiting to move, waiting to buy based on where rates are. But you can see things have gotten better since June 2nd.
I'm just looking at this XHB, I think. I was just looking at the home builder ETF, see if I can pull that over. XHB.
Yeah.
I can actually.
This home builder sentiment survey, this is for new homes and home builders that are out building new neighborhoods and homes, and they are relying on incentives a lot. So 66% of home builders reported using incentives, discounts on the price, discounts on closing costs, additional things that they add in. The average price reduction they're offering is 5%. 37% have cut prices since last month. So just to give an idea what home builders are doing to try and keep selling houses.
And I'm just thinking, Buffett got into which home builders? He put $1 billion in Lennar and D.R. Horton, which $1 billion for him is not that much, but that was one of the big reasons that housing got a boost, along with the drop in rates, as Kyle just mentioned. Like, this is XHB, this is that the home builder ETF from April. We're not even at the prior highs from pre Q1 sell-off of this year. Like, we could go to SPY for comparison. I mean, you can see obviously the S&P is through the highs. So, the stock market is certainly, the XHB and home builders are certainly going to be, I would say, discounting where they expect rates to go. The fact that we moved up, we didn't take out the highs. Oh man, I hope that's not a, and on, again, that little gap up is news of Buffett investing in Lennar and D.R. Horton. Was that little blow off top, and housing start to back off, which means rates stay high and we break top side of that wedge? I don't know.
Yeah, and I mean, if you do go back and follow previous, I mean, they were hoping to lower rates earlier this year. People were hoping for more rate cuts, and as those expected rate cuts have gone away,
right,
that'll put a drag on everything on the home builder side.
Yeah, interesting.
So
right.
I also
love this chart. Keep going.
Yeah. This one is the spread between 10-year treasuries and the 30-year mortgage rate average. And so you can see a few spreads here with the arrows showing pre-pandemic, about 1.82%. We'll call it kind of the premium that mortgage lenders are charging above what you could consider the kind of the risk-free rate, so to speak, which would be the 10-year yield. So normally 1.5 to 2 is the spread you can expect. As inflation spiked, I would argue, I guess, try to explain it from the sense that lenders didn't know how far rates were going to go up. So the spread had to go up because they're taking a risk by writing you a mortgage today while rates are still increasing without really seeing how high they were going to go. So that's kind of why the spread went up to about 3%, over 3% here at the end of 2022, I found, and stayed high throughout 2023 into 2024. And now in 2025, the spread has gone down still above what I would call a normal level, which would, indicate some uncertainty on where rates are going and future. But definitely going back down to that sub two, down from over three, which is probably about as high as it's been.
Which I don't think you finished your sentence there. Like going down to the sub two spread, do you think it happens or not? And let me just qualify that. Like, think about the lenders, the mentality of the, both the local and the national bank lenders. As I'm sitting on 3.35%, hating how much equity I have in my house. I wish I put less equity in this house, but like now, I mean, how many banks are stuck at, this 3.5, even 4%? Like, how long is that going to stick in their memory such that will they let it get below 2%? And will there be, for the foreseeable future, a big spread between where the 10-year yield is and 30-year? Like, are they going to let it get back below 2?
Yeah, I think if as that expected inflation going down, you showed it earlier in this
Right.
presentation. I think that is going to be a big determinant. If you are writing a note and you think inflation might be higher, yields might be higher, devalue the note you just wrote today, by tomorrow when that happens, then I think you're trying to maximize that spread and lower the risk of that happening. But if inflation expectations go down, then you're going to see competition start to set in.
Yep.
More banks will be
Yeah,
comfortable
okay.
offering a lower rate.
So you're saying
and you
short-term
might see
memory
it.
and their capitalistic instincts and greed to get the business will have them drop their
I think
rates.
so, and yeah, and and I mean, there's no question they know how many people are on the sideline with your 3.3. We're below three. I mean, there's no
Good for
chance
you.
of
That's
me
awesome.
moving with
On a
rates
30
being
or a 15 year, not to share all your personal. Are you 30 or 15 year?
30, I believe.
You
Yeah,
got sub 3. That's awesome.
yeah, right
Good
at
for you.
what was it? Right at end of 2020.
That's awesome. Good for you.
So
I mean,
yeah, so
you
I'm
never want to give that up.
it's good, but we're stuck. We
Yeah.
can't move. So
I mean, again, when I
I
bought this
wouldn't
house in
allow the
18,
pay
I put,
double of my just interest. That would be crazy.
yeah. I bought this in 18. I put way too much equity in because it was sort of an uncertain economy at that time. Fed started raising rates 16, 17, a couple teaser interest rate hikes. And I was like, let's just get it in. Man,
Right.
if I put the money in the market instead of the house, like, but who knows? What are you going to do? But
Good old
yeah,
hindsight.
good chart there. That's good. All right, keep going.
Yeah, a couple more things. July home sales prices actually rose, which is surprising. And if you look at um, estimates for the year for 2025, a lot of the big home builder, research companies do expect prices to rise this year. So that's I think also going to keep a lid on the housing market if prices are going up. And I guess I'll throw in a note. It is regional, so the market in Texas is going to be probably different than the market in California. So it is something that you do want to approach with some nuance. Like here in Central Texas, we had a huge decrease in prices in the last couple of years. So for rates or for prices to be going up, that doesn't really mean that they're hitting new highs, but you do have areas of the country where there's huge undersupply.
Yep.
And then those are the areas that are getting the pricing pressure. So just wanted to throw in there that the prices are in some areas they've started to bottom out and to go up again.
That's interesting. And I'm trying to think of the hotspot in Florida. It's not Tampa, but I know Austin is there, and then
Yeah.
there's some hotspot in Florida I think it's West Coast Florida that's coming off pretty significantly. But like you said, it's very regional. Some areas are starting to go up. So housing is becoming more and more a part of the conversation. We're going to really continue to monitor it. I don't know what the takeaway is yet. I don't think Kyle does either. But the fact that we're talking about it so much, we need to monitor it because it obviously
Yeah.
has, it's a very liquid in terms of the home builders and Buffett now being involved. It's a very liquid tell for where rates may go, and then housing supply as well.
Yeah. Yeah. We'll see. If you could tell me where rates are going, I would be able to tell you how the housing market is. I
You
mean,
you
like
betcha.
how many
I
and
would
how
say
many
there's a
people
50% chance of them going higher or lower from here.
guaranteed 50% chance.
Yeah.
It's yeah, and how many people are there out there like us that are waiting on rates to go down? And if as rates go down, what is that going to do to housing prices? Is there going to be a flood of demand and cause prices to go up a lot?
Oh no, or is there going to be a flood of supply? Well,
Yeah, if they're moving, yeah,
but
it
you
would
got to go
cause supply.
somewhere.
If they're first time, then yeah, that would just increase demand alone.
I mean, our majority of our clients are at that point where they're downsizing houses, and one of the higher end, larger housing markets come to market where the smaller condo, the smaller sizes, as people the boomers downsize.
Yeah.
Probably that's where that goes. But anyway, all right. Well, good stuff. Really good stuff. So yeah, markets are. I'm kind of watching. We're having a decent day. Nasdaq's down 0.6 now, 0.69%. S&P's down 0.5. So markets are getting weak again. Yeah, we'll see. I mean, we do have Nvidia coming up next week on earnings. That'll be a big one. Earnings season has been solid, but you just got to keep in mind that we're watching the sell-off. It's August. This is like the middle. This is like the very key. This is the week of summer doldrums. People are trying to, get as much rest and relaxation as they can. The old saying, which I don't know if there's any truth to it, they're like the junior traders are on the desk, the senior traders are in the Hamptons and the south of France sunning themselves, and we're here grinding away, Kyle. So they say erratic moves come into the market, but I don't know. That's an old whatever. But it is August and things get whippy. We certainly saw it last year. This thing could manifest. We do still have half of a VIX hedge on, but I would say the technicals of the market continue to stay strong. And well, I'm ready for anything. September is seasonally the weakest month of the S&P, so we're also going to be watching that. We've had a really good year performance on the portfolios. I really want to protect that. So I don't know. Going in eyes wide open. We'll see. Closing thoughts, Kyle?
Yeah, we'll see. I mean, it's that part of year, and I think things have been so good. Would a sell-off be? Would that indicate weakness, or would that indicate profit taking and just consolidating such a decent year so far?
Yeah. All right, let's finish it there, man. Wow, 103. We said we were going to get more concise. Imagine if we actually put planning in there.
I know.
But I don't know. It's the first time in a couple of weeks you and I really went at it together. And again, we're trying to summer a little bit ourselves and just kind of rest up and get ready for a strong close to the year. So, but good stuff, man. Well done.
Thanks. Yeah, likewise. And
you look sharp today, dude. You're almost bordering on preppy.
I know. This is preppy with polo and we got Alice a matching polo, so she's preppy like me and Kat now.
Dude, I hate to say it, like with that nice, your hair is combed, you got the beard shaved, you're approaching on JD Vance right now.
Just people don't meme me like JD Vance has gotten memed. Have you seen all those that have come out? Or go ahead. I'll probably laugh if anyone does. So whatever.
Oh, man. Yeah, like I should be talking. No, I'm just kidding. You look good, dude. Well done.
Yep. Good talk.
All right, dude. I'll leave it there. I'm on CNBC tomorrow morning at 5:30. I think I'm going to bed in a couple hours. So, no, I'm kidding. But hell, that was a good prep. I love talking macro and fundamentals with you. You help crystallize and bring different concepts in. So I think I'm already good for tomorrow. So.
Yep, good stuff. I
All right,
enjoy
dude.
it, and thanks everyone for tuning in.
Yep. And clients, I will eventually get this live stream thing figured. This is such a weird system, but the idea when we set out this, we will have at some point we will click off of the public and then go into clients only within my.insideedgecapital.com for all clients, where we will get into the specifics of the portfolio, go over performance, specific moves and equities that we're looking to add, cut, or whatever. So we will be working towards that soon, I promise. We'll get there. So, all right, thanks. Let us know if you have any questions at all. You know how to reach us, clients. You have both our numbers, email. Nick is here as well, waiting to help. So let us know if there's anything that's coming up. Thanks again. And Kyle, I will talk to you soon.
See ya.